Well, hello traders and investors. My name is Roger Scott. I'm the head trader for Wealth Press. Today is Tuesday, December 8th. And what are we always doing? We start off with the indices. Remember what I've been telling you. The market is in a weird mode right now. You've got the NASDAQ 100 in comparison to the S&P, the Dow, and the Russell and the mid-cap. And what we're seeing is one lead and the others follow, or the others lead and the NASDAQ follow. Even when they're up or down, let me show you what I mean. Look at the NASDAQ 100. All of the indices are down, but the NASDAQ 100, it's at 12,000, right? And it's down 41. The Dow is at 29,000 and it's down 90, okay? So the value of the NASDAQ is almost 3 times the value of the Dow, but the NASDAQ is down about 2.5. So you could see here that the NASDAQ, the tech, is the most feared index. So whenever you see the NASDAQ 100 weaker than the rest, and I explained this to you yesterday, it's kind of like NASDAQ 100 versus everything else, versus the Dow, the S&P, and the Russell and the mid-cap. And if you see the NASDAQ 100 really cool off by a big percentage, that's telling us that markets are less fearful of COVID and more into the new world reopenings and so forth. So there's like this shift between the NASDAQ and everything else, And again, as I've said, the market is overbought right now. So you may see a cool off of everything, but on a relative strength basis, you may see the Russell continue leading versus the NASDAQ 100. But again, the overall complex is overbought. And I've mentioned this at the beginning of the week. Let me show you. This is the put to call ratio. And I got a couple of questions on it, so let me explain to you what it is. The put to call ratio is like a rubber band. And most of the time, a rubber band is completely useless. I mean, it just doesn't do anything. It just kind of goes like this. But sometimes you stretch out a rubber band. So we only need to focus on this, and let me go to 11 months. Put to call ratio when it's near extremes. What is an extreme? Anything below 0.70 or anything above 1.2, okay? So if we're looking below 70, that means market is bullish, way too bullish and needs to cool off. If it goes below 1.2, that means the market is overly bearish and we need to go higher. So when it's below 70, that means greed is ruling the market. And when we go above 1.20, that means fear is running the market. And right now, as you can see here, we're really close. Every time we get to these levels, as you can see here, we turn down. And it looks like we're going to be turning because it just can't go much higher. That means that the call buyers are just too exuberant and that rubber band is stretched out. Again, that's what that means. So be very cautious and expect a little more downside. Now, let's talk about global economy. Global stocks U.S. futures declined Tuesday as surging COVID-19 infections in the United States and some other countries tempered investment optimism over development of possible vaccines. And that's what I was telling you guys last week. I said the market's ready to go this way or this way. If it goes to the left, that means it's going back to the stay-at-home, basically a repeat of what we saw last March, this previous March and April. If we go this way, that means we're going back to getting to the pre-COVID stage. And I told you last week that it looks like we can go either way. And then as of last Thursday or Friday, I said, no, it looks like we're going back to the stay-at-home because the numbers of COVID cases are just getting too bleak around the world. Investors' worries have risen as some U.S. states and European countries reimposed antivirus curbs on travel and businesses, threatening to drag down shaky economy. California is closed. And what does California make up? Like a quarter of all the world economy, something like that. I don't remember. Don't quote me. I don't remember the exact number. Traders are also watching to see if U.S. political leaders can agree on a new aid plan. Don't hold your breath for the struggling economy after a supplemental unemployment benefit that supported consumers expired a long time ago. And again, on Monday, United States reported 175,000 new cases, over 1,000 deaths, according to data compiled by Johns Hopkins University. So we are not doing well here, folks, in the U.S. with COVID. I spoke to an emergency room doctor the other day who's telling me things are not getting better. Things are getting worse. The word he was using is they are swimming right now, and it's 9/11 every day for them. So he's only talking about Los Angeles and Cleveland, but I don't know if that applies to other parts of the country. I'm assuming it's worse in some parts than others. But again, things are getting pretty bad, and I think we're going to see a repeat, especially based on the put-to-call ratio, especially based on momentum levels. And I'm not going to get into it because I've been doing this every day, but I'll show you what I'm talking about. Let me show you what I mean. Look at this. 89% of stocks in the NASDAQ 100 are trading above the 200-day moving average, which is crazy high. And I show this to you almost every day. Look at 10 years. We are at a 10-year high, the highest momentum level in 10 years. That means 89 stocks out of 100 NASDAQ stocks in the NASDAQ 100 are trading above the 200-day moving average. That's just too much, too fast. And it looks like we need to cool off. So this, with the put-to-call ratio, with the fact that we're seeing divergence, and I know I'm being repetitive, but I need to show you this because my view has not changed. Look at this. Higher highs. Oops, where is it? I don't see it here. Let me put the RSI on. They keep switching it off. They keep taking it off. Why, I don't know. Here, relative strength index. Here we go. See that? Look. High, lower high. Downtrend. Here, let me add a drawing tool. Let me be a Picasso here for a second. Can't even draw. It's not letting me. Oh, here we go. Okay. See that? Downtrend, uptrend, divergence. And it's not just on the S&P, it's on the NASDAQ, and it's really bad. Now, in light of all of that, instead of focusing on the long side, let's focus on the short side. If we look at our cumulative strength index, we will see that this is the strongest stocks, and these are the weakest stocks. Notice Regeneron, BIIB, Dexcom, Insight. Look 6 months ago. I want to show you something. 6 months ago, let's go all the way to the highest. Look at the highest, the best, Regeneron, DXCIM. So the strongest stocks from 6 months ago are now the weakest stocks, and that's okay. So I would focus on these stocks right here. Intel, Guild, VRTX, INCY, DXCM, BIIB, REGN, and SPLK. And again, these are stocks. These are the weakest stocks on my list right now. And remember what happens. When stocks rise, the strongest stocks rise the most. When markets go down, the weakest stocks go down the most. It's a relative strength thing. That's what we use here. This is a 6 month, 3 month, 1 month. And again, focus on selling these stocks. SPLK, REGN, BIIB, DXCM, EINCY. These are all biotechs, and VRTX and Guild. So you got 1, 2, 3, 4, 5, 6, 7. And you know what? Let's throw Intel in there for good measures, because Intel is a terrible stock right now. I'm not liking Intel. But again, if you're going to focus on the biotechs: Splunk, Regeneron, IDEC, Dexcom, Insight, Vertex Pharmaceutical, and Gilead Science. Why? Because I guess these stocks, they were, when COVID was really hot, all biotechs were moving higher. But then with time, over the last 7 months, we figured out that some were going to have a vaccine and some are not. And the ones that did not come out with the vaccine, or are not coming out with the vaccine, or are coming out with the vaccine later, got thrown to the back of the bus, and they're not getting any love. Like, look at Splunk, for example. It must have been earnings or bad news, because I'm seeing a lot of volume here. But look at this. That's a dog. Let's look at another one. Let's look at Guild. Or how about Regeneron? Let's look at Regeneron. Let's look at that. Oh, not good. Yeah. Not good. Not good at all. Below the 200-day moving average. Let's look at another one. BIIB. Oh, below the 200-day moving average. Yeah, if you want to have a little more certainty, then stick with these three: SPLK, Regeneron, and BIIB. But I'm telling you right now, they're all in the doghouse. SPLK, Regeneron, BIIB, DXCM, INCY, VRTX, GILD. That's 1, 2, 3, 4, 5, 6, 7. I'm giving you 7 biotechs that are on my chopping blocks. Now, before I let you go, I've got something very, very big and important for you. What if I told you that one of the most important price indicators in the entire stock market universe triggered every Friday night after the market closed, like 1 minute after the closing bell, and that they could hand you potentially thousands of dollars in profit every single week? A trading phenomena happens every Friday at 4:01 p.m. Eastern Time without failure. And that regardless of what happens, Monday, Tuesday, Wednesday, Thursday, even Friday, all you've got to focus on is what happens at 4:01 p.m. on a Friday. It's that simple. Live Trade Profit head trader Josh Martinez, he made a short video for you, just for you to watch. It explains how you can take advantage of this bizarre market phenomena. You've got to take advantage of it. You got to check it out. Click on the link below, watch the video on how you can get in on this potential profit. And when I saw this, I loved it. Josh is an amazing trader. He's got very, very high credibility. He's just off the charts. And again, watch how Josh shows you how you can make potentially profits at 4:01 p.m. based on data that comes out Friday at 4:01 p.m. Eastern Time. You don't want to miss it. It's super simple. It's educational, and it could potentially be profitable. Check it out. Do it now. And have a great day, and post comments here. Bye, guys.